Yo, what's up, everybody? It is Tuesday, July 16th. Before I start, let me just ask all you nice people, if you don't mind, please like and subscribe. I always forget to say that until the very end. Sometimes my videos run long, and I don't know if you stick around, but I do say that at the end. So please like and subscribe. It helps the channel a lot. So today was a big day, big day, at least in the Dow Jones, up over 700 points. Big day, man. Not so much in NASDAQ or S&P. So the explanation being given is rotation. Rotation because now, and by the way, I talked about this. I think I talked about this on a video last week. Specifically, I think I was talking about rate cuts and small and regional banks. Those stocks should do well. And if I didn't mention it, I know I sent this out to my subscribers. Anyway, so rotation right now, based on where Fed fund futures are trading, we're now looking at three rate cuts this year. So September is a done deal. Now they're factoring in, the market's predicting a rate cut in November and another rate cut in December. So 3 rate cuts now. So of course, this is all this kind of monetarist frenzy going on. Very interesting time, I think, because again, we're coming up against this understanding. Eventually it's going to play out. It's going to play out. And I believe it's going to play out exactly the way I've been telling you guys. I mean, I personally, I can't wait. And I've said that, this is something, I have a history of this on this channel. Going back, like there were times when I would tell you guys, I can't wait until this happens because you're going to come back and revisit my words, what I said, 6 months, 9 months, a year before, when I said such and such a thing is going to happen. All right. So like I'm back now with the, I can't wait until these rate cuts happen. Not because, it has nothing to do with the profits I'm going to make in my portfolio and the profits that my subscribers are going to make as we position ourselves correctly. But just like it's interesting and it's fun to watch things play out the way they should when you have an actual understanding of how these things work. It's just like the same thing that I said when the Fed started raising rates, and I said, you're going to come back. I don't know how many of you did come back to it and revisit my words, but I said it's going to be bullish because you're going to get this massive increase in interest income transfers into the economy, and it's going to support economic growth. It's going to make it harder for the Fed's inflation target to get hit. Now, inflation is coming down, but that's not because of the interest rates being high. As a matter of fact, the interest rates being high has probably slowed down the process of inflation coming down. I mean, originally, the original cause of the inflation was the pandemic. Because when we had the pandemic, the supply chain got shut down all over the world. Actually, if you want, you could even go back to the Trump presidency in 2018, 2019, when he put tariffs. I mean, you could literally go back and look at a chart, and the initial impulse was during the Trump presidency. That's when it started, and it started with the tariffs on China. And by the way, Biden kept those tariffs on, okay? So, I mean, you can go back and look at a chart, and it actually, you could see it, that it started taking off around 2018, 2019 with those tariffs, all right? And then we had the pandemic, and so that was the cause. And, now it's coming down because the growth rate has dropped. I mean, in 2022, we had like a 8% GDP growth rate. And last year we had like I think it was anywhere from like 3.5% to 6% growth rate. This year it's like 1.5 to 2%. So I mean the growth rate is slowing down. And the growth rate is slowing down because the fiscal has come down, all right? Those transfers, like in 2021 or something, we had a 3 trillion net government transfers, all AKA the deficit, okay? That was what, in 2021. In 2022, it came down. Last year, it was down to 1.7 trillion. This year, it's probably going to be around 1.4, 1.5 trillion. So the shrinking in those net transfers, right? What are net transfers? I mean, that's literally money into the economy. And that's not credit. That's not like bank money. That's dollars into the economy. So that's money that comes in with no offsetting liability. Like that's money that we have. And that's shrinking, okay? So inflation is coming down, not because the Fed kept interest rates up. If anything, keeping interest rates up has kept the inflation rate higher than it would have been if they just put the rate back down to 0 or 50 basis points or something like that. So I'm excited, folks. I am excited for when they start to cut rates because I've been sitting here telling you guys that, be careful what you wish for, be careful what you hope for, because it's not going to play out the way you think. And a lot of what we're seeing right now in terms of the stock market rally, and I do believe this rotation is a real thing, okay? I mean, let me address this for a second. Just like rate increases were positive for certain sectors of the market and the economy and negative for some other sectors, like I've been talking about the small banks, they got hit really, really hard with the rate increases, okay? And for a while, tech was hit really hard, but then it started to come back with the whole AI paradigm and stuff like that. But so you got to think, and I've always said this to you guys, all right? You have to think about interest rate changes. All they are, they're price changes, okay? And they are changes in how income is distributed. All right? When you raise interest rates, that's an interest income transfer to the economy. It goes to creditors and savers. It hurts debtors. Okay, remember the economy, the non-government is a net creditor. People might say, Mike, how could you say it's a net creditor? We got so much debt. Because there's 34 trillion. That's the so-called national debt, right? That's what the non-government holds. We own those securities. So we're a net creditor to the government. It's not really credit in the way we think of it. We're not lending that money, but we own those securities. We own those dollars, and we get an interest payment on that. So the way to think about you can't get all like freaking, hyped up and hysterical and everything about interest rate. Listen, I'm telling you guys, I'm just trying to reduce this to the simplest common denominator so you could just understand this like a scientist, non-emotional, like, oh, they're cutting interest rates, they're raising interest rates, oh my God. No, just think about it. Rate adjustments are price adjustments. They affect how income is distributed in the economy, right? Do creditors gain and debtors lose? Do debtors gain and creditors lose? And they're also fiscal operations, okay? So when the rates go up, the government increases its interest income transfers. It pays more interest. When the rates go down, that interest income is taken away. It's reduced. Okay? So I want you to think from now on, whenever they talk about this stuff, you got to say, oh, good. What area of the economy and the market what sector should I be focusing on? Not, oh my God, I got to sell, or oh my God, I got to buy. That is a very unsophisticated, lack of understanding way of looking at it. And that, believe me, folks, that's what 99.9, 100% of the people out there do. I'm explaining to you, you could just calm down and relax. And when these things happen, when you get these policy changes, if you understand the impact as an investor, then you say, okay, great. Where should I allocate my capital now? Because I understand that such and such a policy change is going to affect this sector of the economy positively and this sector of the economy negatively. You don't go hysterical and say, oh my God, I got to sell, or oh my God, I got to buy, because then you know nothing. If you were doing like all these other, and believe me, I'm telling you right now, all of this stuff, and all of these people who are talking about interest rate cuts, and I think the market has not already, but is in the process of discounting a major part of these actual interest rate cuts, okay? In anticipation of these cuts. Maybe today we got another boost because now it's 3 rate cuts instead of 2. Up until today it was 2. Now the market's pricing in 3. So, okay, whoop-de-doo. So I'm going to be in the areas, I'm telling you right now, the economy is going to slow down. I'm going to be in the areas that will benefit. You got small banks, even though the economy is slowing down, their capital improves significantly because they hold a lot of government securities. This was part of the problem, that when the Fed raised interest rates, it decimated the capital base of these small banks, okay? That was bad enough, but then the small banks, they're not like the big banks, where big banks hold most of the reserves in the system, most of the cash. The small banks had to pay up for those deposits. And so that hurt their margins even more. All right? So they're at least going to get the benefit of an improvement in their capital, which are primarily the government securities that they hold as tier 1 capital. And remember, capital, that's the only constraint on bank lending. All right, it's not deposits, it's not reserves. Capital is the only thing that can be a constraint on bank lending. If the bank's got to have enough capital to back its assets, of which loans are part of their assets. All right. The other thing I want to talk about is gold, because you had a big today. Gold made a new all-time high. And this is driven off of the interest rate anticipation. I am telling you right now, and we're going to come back and revisit this. Maybe some of you will, maybe many of you won't. I certainly will. I'll remind you that I said this. What's today? Today's July 16th, 2024. I will remind you that I said on July 16th, 2024, that gold is going to go down when they cut the interest rate. All right, now everyone's buying it. There's this belief, and it's funny to me because like we've had this monumental rally in gold, and if you go back like 2 years, I was telling people at the time, when just before the Fed started to raise interest rates, or when it started to raise interest rates, I said that producers had the smallest short position in gold at that time in something like 8 years. In other words, they were positioned very, very bullish. I kept saying it. I don't know if I see, how many times I said it on the videos, but I definitely said it on my subscription service. And I don't know, where were we? Like 1,600 in gold at that time, bopping around in that area. And I said, this is major, major bullish, okay? Now, guess what? Producers have the biggest short position in over 2 years, okay, in 27 months. Biggest short position. They're selling this rally. And how many times have I told you guys, I never go against, like when it comes to physical commodities, it's different with cash settled commodities like S&P and you know, those kind of things. But with physical commodities, where you could actually take delivery of this stuff, that's a whole different ball game. You never, like oil is in that category, gold, silver, okay, copper, the grains, agricultural. You never go against the producers. Now, it may be so that it doesn't happen on an instant, but I'm telling you right now, you can believe it, or you can go with this belief that when they cut interest rates, it's going to be bullish for gold. The bullish for gold has already happened. And it's happening still a little bit now, but I'm telling you right now, if you think that the interest rate cuts are going to cause gold to go up, and it's not that I'm bearish on gold in the macro, but I'm saying, I'm telling you right now, and we're going to come back and we're going to revisit this, folks, together. All of us together, we're going to revisit. It's not going to be bullish for gold. It's not going to be bullish for silver. All right, so the people who are buying now, and I've been talking about this for a while now, those who are coming into the markets now, these are people who were very, very negative at the beginning of the Fed's rate hike, you know, regime program. And they were all wrong. And now they're coming in for the same reason, but with the opposite understanding, which is the wrong understanding again, but they're applying it just like they applied the wrong monetarist understanding when they started raising rates. So I'm just going to end up by saying, I can't wait. I can't wait. This is fascinating. I mean, this, to me, it doesn't get any more fun than right now. I mean, I love these turning points where you're getting like a tectonic shift, you know, in policy and stuff like that. In the middle, like when it's all going in one direction, it's kind of boring. I mean, it's nice because you make money, especially if you get in early. Okay, and if you have the patience and the discipline and you wait it out and things start to change. But I love, like right now, when we're at the precipice, we're at the, you know, coming to the point where we're going to get a major policy shift. And everybody's still running, you know, on the wrong beliefs based on the old policy shift. And I'm sitting here and I'm telling you guys, man, I cannot wait. And I hope you guys cannot wait. It's going to be a lot of fun. And this is really fun. This is when it really gets interesting. And also, I just love testing my understanding. And I don't feel like it's any kind of a test to me. I mean, it would be like, you know, like Usain Bolt saying, we're going to test you in the 100-yard in the 100-meter dash. I mean, come on, he's a world record holder for crying out loud. So it's not really a test to me like, am I going to be right or wrong? Let me see if my theory is correct. No, I know it's going to be correct. And it's just fun. It's fun. What can I tell you? And I don't expect everybody to go along with it. If everybody went along with it, like in the understanding, in the frame of understanding it, then I'd kind of be nervous, you know. It's good that the vast majority are skeptics about it. It's good. It's good for all of us, man. The one, you know, if you're here watching this stuff, or better yet, if you're one of my subscribers, I mean, the fun is about to begin. We got a few more months to wait. September. Now we got 3 rate cuts coming this year. So everything I've been telling you about the reduction in those interest income transfers, That's just going to be more, even more than what I originally planned, because now we got 3 rate cuts coming. And remember what I said, I'm going to leave off with this. As soon as they start cutting rates, it sets in motion a cycle of more and more rate cutting. I explained that last time. Just like when they started raising rates, it set in motion a cycle of more and more rate increases. So it's going to be fun, man. The ride is just getting started. Anyway, thanks for watching. I appreciate you guys. And please like and subscribe. Helps the channel enormously. And it costs you nothing. And if you'd like to sign up for a 30-day free trial of MMT Trader, go to my website, pitbulleconomics.com, and take advantage of that. See you tomorrow. Bye.